We're now getting to the heart of the matter, how to make a deal. Let's make a deal using ID system. It's simplicity itself. In times past, such business could only be done on the trading floor. When the telephone was invented, it rapidly became the primary trading tool. Now, with the advent of the internet, we can trade through it.
First, we decide which currency pair we want to work with. We choose the euro. Then we decide how big our lot should be. A lot size 1.0 is 1 million euro. We want to be less ambitious. If we wanted to trade 10,000 euro, the lot size would be 0.01. We want to work with 100,000 euro, so our lot size is 0.1.
Now we need to know the currency rate, so we click Request Price.
Answering our inquiry, the broker sends us two prices, a price we can buy at, the ask price, and the price we can sell at, the bid price. The broker's answer: sell 1.2244, buy 1.2249. We can buy euros at 1.2249 and sell euros at 1.2244.
At this moment in time, the broker has no idea about what we are going to do.
We give the order to sell. The broker confirms the purchase of 100,000 euro for dollars at the 1.2244 price, and that's it. The deal is done. It's simply a matter of a few clicks of the mouse and a minute of time with the help of Forex Club International's trade terminal, ID system. The professionals would now say that we have an open position, but there's more.
If we have an open position, it's necessary at some point to close it. Never forget, profit or loss is only fixed after closing the deal.
We close a position in a very similar way to opening one, but if the opening position was sell, to close it we buy, and vice versa. This is what it looks like, and there you have it.
We've made a profit. Let all your future trades end like this.
By the way, for your information, when you open a position using the buy command, we say you are long, and when you sell, you are short. Why? These terms come to us from the commodities markets. As a rule, the price for the goods grows very slowly, over a long period of time, and falls very quickly, over a short time.
And from this come the terms prices going up, go long, prices going down, go short. More tradition, ladies and gentlemen. It's very simple to calculate the income from your deal. All you need to know are the number of points you've earned or lost.
When US dollars are not the base currency, a point equals $1 for every lot of 10,000. So if you've bought 50,000, it's $5 a point. Have a look at this example. You have bought 100,000 euro at a price of 1.24 and sold at a price of 1.2450. You've earned 50 points. Multiply this by 10. You've made 500 bucks on the day. When the dollar is the base currency, it's slightly more complicated because the cost of a point floats. Here is an example. You bought 20,000 Swiss franc at 1.24 and then sold at 1.2450. The selling price is higher than the buying price, and that means that you have made 50 points. We calculate the cost of 1 point at the closing price of the trade, 1.2450. Divide 1 by 1.2450 and we get $0.8032 for each point. The total is $80.32. That's your earnings.
Now that buying and selling are clear and we know how to open a position, we need to move on to discuss the most important and useful tool in a trader's toolkit, the order.
What is an order? It's a command to the broker to carry out a currency transaction when the price of a specific currency reaches or falls to a prescribed level. Now, for example, the euro is at 1.24. We reckon that when it reaches 1.224, there'll be a sharp rise in price, and we're ready to buy at this price. We give the broker an order to buy 100,000 euro against dollar at the price of 1.2240. That's all there is to it. The first advantage of such an approach is that we do not have to follow the market. We can go off and relax. The second is that the deal will be made at exactly the specified price.
Any psychological distractions like fear or indecision are definitely eliminated. There's nothing further to do technically either. The order has been placed and will remain active unless cancelled. Of course, it's perfectly possible to close a position as well as to open one with an order.
The most important closing order is a protective one known as the stop loss. This order limits the amount of money we can lose on a position, as it closes the position when price has moved against us to a preset level. In this way we manage our risk by deciding in advance how much we are prepared to lose. A stop loss is usually placed with a take profit order, and this order closes a position when a certain level of profit is reached. When the order has been placed, it is designated active. As soon as it has been carried out, it is designated done. And this is how they are recorded automatically in your trading reports by ID system. Ideally, we should place stop loss and take profit orders simultaneously. But if one of these orders has worked, it's necessary to remove the second.